You're very welcome to this pre-scene analysis of the August 2019 operational case study by CIMA. And this pre-scene is based on the fictional business of AKL Sparkle, a company involved in the design and manufacture of silver beads for bracelets. So over the course of the next 10 or so videos, I'll be walking you through each of the pages of the pre-scene document. We'll be highlighting all of the most important points, and I'll be relating them to your E1, P1 and F1 studies and talking about likely exam issues and how you can confront those issues. So, without further ado, let's take a look at the opening section of this pre-scene. We're told in the introductory section that AKL Sparkle is a company that designs and manufactures silver beads for bracelets. The bracelets themselves, which are made of either silver or leather, are actually bought in by the company. So the company AKL Sparkle is not making the bracelets itself. Instead, they focus on making the silver beads that you put onto the bracelets. And they sell via a number of retailers. So AKL Sparkle is not actually selling directly to the public itself, and we'll talk about the implications of that fact as we move through this pre-scene. AKL is based in Newland, a fictional country based in the non-fictional continent of Asia. We have very little information about Newland throughout the pre-scene, so we don't really know a lot about the socio-economic status of the country. There are a couple of little hints later on in the pre-scene, which we'll discuss when we meet them. We have a fictional currency as well for this fictional country, the N dollar. And we know that this business is not exporting, for example, but it's quite likely that they are importing. It's likely they're importing silver. The main manufacturers of silver in the world reside in the Americas. So because this company is based in Asia, it's quite likely that they're importing silver, which is by far and away their most important raw material. So they're going to be exposed to currency risks, given the fact that they have the N dollar, and they'll be trading with companies who manufacture silver based in countries like the United States with the US dollar, or other countries in the Americas, for example. So, AKL Sparkle was founded in 2005 by a husband and wife team, Chakri and Kim Lee. So they own the business in its entirety, and they also occupy the most senior positions at the company. So they have huge influence. So they're not just shareholders, they're also executives in the business. They've overseen a period in this 14-year period of rapid growth. So they've gone from being artisan silversmiths with a staff of 4, very, very small company when they started out, to being a large business of 829 staff with a large purpose-built factory. So we might expect to see, for example, when we look at the financial statements later, high depreciation expenses related to a highly valuable fixed asset such as this purpose-built factory rather. And that obviously would impact the profitability of the company, relating there to F1, IAS 16, property, plant and equipment. So this is a family business, a husband and wife team, and that has implications. There are pros and cons that come along typically with family-run businesses. For example, on the plus side, family-run businesses tend to take a longer-term view. They're perhaps, especially if they're a private company like this one, they're not going to be subject to the pressures of the market. They're not going to have investors pressuring them for short-term profitability, so they can do the right thing over the long term and make plays that affect the long-term sustainability of the business rather than focusing on short-term profits at all costs. When things are going well with the family-run business as well, there's a sense of solidarity, everyone pulling in the same direction. However, on the negative side of the equation, when things go badly, things can really go horribly wrong for family-run businesses. Feuds between family members who have shareholdings in a business tend to be particularly bitter as they jostle for influence. They might be trying to impress a father or mother figure who is heading up the business. That doesn't seem to be the case here, where you have children fighting it out for the favour of Chakri and Kim Lee. There's no mention of any children on the scene. However, also, family-run businesses tend to be a little bit conservative and they can be resistant to change. And I do think there are a couple of indications in this pre-scene that might be the case for AKL Sparkle. And nepotism is another common problem with family-run businesses. That's not a problem, though, for this business, given the fact that there is no mention of any children working in the company. What I would say at this early stage, and it will become transparent as we move through the pre-scene, that this company, tying into that resistance to change, one of the drawbacks of being a family business, they seem to be very reliant on just one product category. Their thing is silver beads made for bracelets. They're not doing anything in necklaces or other jewellery categories, and I do think that exposes them to risk. They need to diversify away from that reliance on just one product category. Moving on then, we're told that the general thrust of the jewellery industry in Newland in the early 2000s was away from a fixation on gold, with silver demand exceeding the demand for gold for the first time in the early 2000s. And with that, you had the emergence of interchangeable jewellery pieces. So people were buying single beads to attach to bracelets and necklaces, etc. And depending then on the occasion, they could wear different silver beads. And the fact as well that silver is a little bit cheaper than gold would facilitate that change of trend. So people are looking to change their bracelet to create different looks for different occasions. And that kind of reminds me of what's happened in clothing with the advent of fast fashion, which is predominantly associated with Zara, which it's all about turning out the latest styles that are seen on the catwalks of Milan and Paris, etc., before the big luxury clothing providers. So Zara tries to beat them to market, and it has very disposable kinds of clothing that people buy cheaply and then throw away very quickly as well. So they're changing their looks very, very quickly. Something similar happening, it seems, in the jewellery industry with these more accessible forms of jewellery that can be changed out quickly and inexpensively. So some of these jewellery pieces are encrusted with precious stones, and that obviously would add expense, but there's not much indication of that for Chakri and Kim Lee's company. So in the early to mid 2000s, beads tended to be of a very high quality. Typically a single bead would cost $15 to $100, depending on whether they were carrying these precious stones or not. And what we see is that when Chakri and Kim Lee launched AKL in the mid 2000s, that they took advantage of a gap in the market. There was a gap for mid-level quality, and they were selling single beads at $8 each. So that represents 10 to 50% of the price of established producers. And that is a very strong business strategy. It's a very, very compelling offer, and they particularly appeal to younger people, 17 to 30 in ages. And that's not surprising, because this age group is not yet financially independent in some cases for the 17, 18, 19-year-olds, still relying on their mum and dads. or they're not yet in the prime earning years of their lives. That would be the case for people in their 20s up to the age of 30, where they're starting out in the world of work and they don't have huge purchasing power. So those people are not looking for high-end jewelry pieces with precious stones, etc., but they're still interested in expressing themselves and purchasing jewelry of some kind, and that's the gap that Chakri and Kim Lee filled in 2005. And what this meant as well, these lower priced beads facilitated the regular purchase of new beads because they were accessibly priced. So this is a volume business. Rather than selling few pieces at high prices, they're selling higher quantities at low prices. And very interestingly, it says here as well, although it started out as jewelry targeted at females, that males also started to take an interest in these bracelets with interchangeable beads, and they became a significant portion of the products, all of the products sold by AKL. The one thing I would say here is that it might be slightly concerning, this reference to the mid-market. When I think of that term, I'm reminded of Michael Porter's generic strategies, you might remember from your E1 studies, where a brand can be differentiated, typically at the high end of the market, very high quality, charging more premium prices, etc. Or it could try to be a cost leader, really holding costs down, going for a very basic offering and targeting a wider group of consumers. And the danger Michael Porter flagged up is for companies that get stuck in the middle. So they get kind of caught between a high price offering and a low price offering. And that is certainly, I think, something that we might be just keeping an eye on as we work through the pre-scene. Could it be that this mid-market offering could come under attack and become a little bit unstable? It's going to be important, I think, that AKL controls its costs, because it's not going to be able to offer something at a very high price. So if it wants to keep making profits, it will need to keep its costs under good control. Moving on then, and we're told that AKL Sparkle sells two types of bracelet: sterling silver chains and leather cords. They are bought in rather than manufactured, and they come in two different sizes. So what they're specializing in is designing and manufacturing the sterling silver beads that sit on these bracelets, the silver bracelet or the leather cord. Thinking back to your P1 studies, you may recall that with less variety, you're going to have fewer production setups, less complexity, less cost, and you can pass on those savings to your consumers. So that ties in with what I was saying before, the danger of being stuck in the middle, according to Michael Porter's generic strategies. It's important that this company keeps its cost down, and one way certainly to keep costs down is to lessen the production complexity, to lessen the variety of products offered. So there are indications that this is a company not offering a huge amount of variety. Certainly it's signalled by the two sizes of bracelet and the fact that they either have silver or leather. So fairly basic offering there. However, they do design, manufacture and sell a range of sterling silver beads, and that's constantly changing. So that actually is introducing a little bit more variety. So there's kind of a tension there. And that might be introducing more cost to the business. So that's something that maybe they want to look at. If they want to hold down costs, it might be just worth fixating on a more limited range of silver bead offerings, the most popular ones, to reduce the number of production setups and lessen complexity and pass on savings to the end consumer. So we're told that the beads are sold individually and they're designed to fit snugly on AKL Sparkle bracelets, but they also fit bracelets that competitors sell. So they're offering their consumers flexibility. They can buy beads from AKL Sparkle, which is predominantly what they want to sell, rather than the bracelets, which are likely to be of less value. So they can take those beads and slip them onto competitor branded bracelets if they so wish. In the next paragraph then, we're told, interestingly, that AKL Sparkle is not selling directly to the consumer itself. Instead, it goes via retailers in the form of jewellery wholesalers and other retailers that we'll talk about later on. It doesn't own its own or operate its own retail outlets, and it has no online retail presence, and that is interesting. So when we discuss distribution channels as part of the 4Ps place, we notice that this is a business with decent reach in its domestic segment. We'll talk about those retail segments in more detail in a few pages' time. But I do think they could easily sell via their own stores, given the strength of the brand, which we'll talk about in a little while. And certainly I think they could sell online, given the fact that these beads are small, they can be easily transported internationally, they're low bulk, and they don't need to be tried on in the same way that clothes do. You could easily imagine people going online, selecting their beads, and being quite satisfied with that and ordering them online without too much difficulty. Given the fact as well that this is a company with a young group of consumers, young people are likely to be more tech savvy, they're comfortable with purchasing online. All of that, I think, points to the need for AKL Sparkle to start selling their beads online. So they don't have an online retail presence. What's not clear though is whether they have a website. So they might have a website, but they're just not selling through it. They might be advertising and promoting and trying to influence the buying decision with a website, but it's not mentioned throughout the pre-scene. Another limitation that the company faces is the fact that they're only selling domestically in Newland. So I do think that likely exam issues might revolve around exploring growth options in new markets and new product categories, given the fact that they only sell domestically and that they are only present in one product category, i.e. bracelets. So this is a privately owned business, and when we contrast that to a stock exchange listed business, there are pros and cons with both. Being a privately owned company, there aren't the same public pressures that come with being a stock exchange listed entity. There aren't the same onerous regulations that come with being listed publicly, and inspection in the form of obligatory audits, the publication of financial statements every quarter, and analysts asking difficult questions, etc., about growth prospects. But on the other side, there are limited financing options. So this company is likely to be limited to debt funding. And there are signs of debt funding on the balance sheet, but we'll talk about that when we look at the financial statements later on. So in the next paragraph, we're told that the market for bracelets with beads, such as the ones sold by AKL Sparkle, are dominated by two large international companies, Starbright and BAJ, and they control their own distribution channels and they exert significant influence over their suppliers. So these are big companies, they're dominant in their market. They're likely to enjoy economies of scale, which would lead to lower costs. They have buyer power over their own suppliers that can negotiate bulk discount purchases. They have lots of resources for big capital expenditures. So it's likely that they have a degree of vertical integration so that they have suppliers, their own suppliers and their own retail presence. And there are pros and cons that come with that. Obviously, they're going to exert more control over the entire value system. They have better supply chain coordination. As I said, they're likely to enjoy economies of scale. They can consolidate management across different businesses that they own and lower their unit costs and pass those savings on to the end consumer. On the other side, though, these businesses are likely to be very capital intensive. They're not going to be as flexible as a little company like AKL Sparkle. If they want to make a sudden turn, they have to turn a very big ship and are less likely to be suited to that than smaller businesses would be. And they could lose focus being present throughout the value system. On the contrary then, AKL Sparkle is operating in a niche area. It has found favour with fashion-conscious consumers, the 17 to 30 age group. They are looking at value, so we're talking about lower price points. And with those lower price points, that facilitates a higher level of repeat purchasing. So as I said, this business is being driven by volumes, with those lower prices facilitating repeated purchases. And what AKL has done is carved out a niche for itself, and they have a strong, distinctive brand. And this area of the market, we will see later on, is becoming increasingly competitive, and brand allows a business like AKL to differentiate itself in a crowded market. So brand power, marketing is going to be important for AKL if it wants to stay ahead of the pack. We're told that there are a number of smaller size competitors outside of the two dominant forces, Starbright and BAJ, and they range from budget end providers to luxury end providers, and that means that we're probably dealing with a perfectly competitive marketplace. So, because we're talking about companies with strong, distinctive brands, such as the case with AKL Sparkle, we're talking about going beyond the purely functional. It's about intangible qualities, the desirability of these products, and brand plays a really important role here, and marketing as well. And it's interesting because marketing is not actually mentioned too frequently in this pre-C, and I think it's actually a failing of AKL Sparkle, and one they need to turn their attention to. So we've got a younger consumer base. They're likely to have less disposable income, as I said before, and that is drawing them to AKL Sparkle with its lower price points. It's worth mentioning, I think, at this early stage that this might be a business that is an attractive takeover target to the two giants in the industry, Starbright and Badge, especially if they were predominantly operating at the luxury end or the budget end. They might want to go for something a little bit different. As we said, AKL has carved out a niche. They're a profitable business. They've got good revenue growth. And it seems as well that the owners of the business, they're not spring chickens. They're probably close enough to retirement, so they're likely to be asking questions about what's going to happen when they leave. They might be thinking about an exit strategy. So it's not outside the realms of possibility that they could, encounter an offer from one of the large international players, Starbright or Badge. So let's take a look at your role in AKL Sparkle. You're told that you're a finance officer working in the finance department of AKL Sparkle. You're primarily responsible for budget and variance information, so that would relate to your P1 studies, so in the area of management accounting. You assist Jack East, who is the head of finance, so it's likely on the day of the exam that you'll have plenty of interaction with Jack East. You'll likely be receiving emails and requests from Jack to assist him in various ways. So apart from your responsibility in the management accounting area, you are also in general assisting decision makers of various kinds. So it's not just finance colleagues that you could be dealing with, but you could also be dealing with requests for information from other managers in different business areas such as sales, HR, IT, production, etc. This unfortunately doesn't really narrow things down for you. In other words, you should expect anything on exam day. You'll be asked to call up your knowledge, not just from P1 or F1 indeed, but from E1 as well. So thinking about marketing, HR, and all the other areas you came across in E1. So as well as assisting managers in other areas of the business, as well as making decisions and assisting with budget and variance information. You will also be expected to help out on occasion with the financial statements. So calling up your F1 knowledge. So all of this information has something in common in that you are being asked to assist. You're assisting the decision makers. You yourself, as a lowly finance officer, will not be taking the big strategic decisions. That will be left to people like Jack East, the head of finance there, or to other directors working in the area of production, sales. Jack's boss as well, the director of finance, for example, would be setting out the strategic course of the business over the long term. Instead, you're going to be helping these people execute on day-to-day activities. That is what the operational level is all about. So you'll be expected to draw very much on your technical skills, the ones you should now be very comfortable with from your P1, E1 and F1 studies. Remember that for the case study exam, there are 4 competencies that you are tested on. Business skills, which account for about 16% of the total marks allocated. Technical skills, which account for the overwhelming majority of total marks, 64% of total marks for the operational case study going towards technical skills. And then you have leadership skills and people skills making up the rest of the marks. So there's a minority of marks assigned to those 2 final skills. They become more important as you move up through the levels, through to management level and strategic level at CIMA. But at the operational level, it's still very much about showing your technical proficiency. Now, a lot of people worry about that, and they think that on the day of the exam, they're going to be asked to do very detailed calculations. It's not going to be like that. Instead of being asked to do detailed calculations, what you will more likely be asked to do is to comment on, for example, a table that has been attached to an email, and you'll be asked to make sense of the numbers already calculated and presented. So rather than starting from scratch and you being the one to calculate those figures, you'll be given a table of figures and be expected to comment on them, to watch out for any mistakes that are being made in the assumptions. For example, of a non-finance colleague, you might get a HR director coming to you with some budget variances or something like that, or a sales director, and asking you to comment on them. They might have made some faulty assumptions and you'd be expected to set them right, but you won't be expected to do detailed calculations on the day of the exam. As a finance officer then, as I said, you're low down the pecking order. You're going to be reporting into managers and heads of finance and directors, etc. So you're not the one making the big decisions, but you are going to be assisting them. You'll be providing them with useful information that they will then take to make big strategic decisions. Your focus is going to be on the short term. So what I mean by the short term is, as I said before, you'll be very much fixated on day-to-day activities, operational excellence, and you'll have a time horizon most likely of 1 to 3 months, maybe up to 6 months, at most 12 months. That would be the time horizon relating to the assistance you give with the decisions being taken by your bosses. Costing is going to be important. That relates to P1. It's quite common, for example, that you might be asked to compare a standard absorption costing system that a company has in use and to contrast that with activity-based costing and talk about why it might or might not be suitable for your organization. Budgets are going to be important, and comparing budgets to actuals and looking at variances in sales figures, for example, they're very common questions at the operational level. And indeed, we will be presented with budget figures later on in this pre-scene, and we'll talk through those figures in detail. Working capital management, then turning to your F1 studies, is going to be an important area of concern, looking at trade receivables, trade payables, inventories, etc., and looking at the cash conversion cycle and seeing whether optimal decisions are being made in relation to those areas. And we'll be talking about that when we look at the financial statements of AKL Sparkle. And cash management then would follow on from that. We'll see in the financial statements that this business, for example, has bolstered its cash position in the last year, and we'll talk about why that is when we look at the cash flow statement. And overall, assessing risk over the short term to see that the company is hedging its risk in the right way, mitigating risks to the business. It's important also to point out that CIMA is very keen on ethics over all three levels, the operational, management and strategic levels. So do look back over the CIMA Code of Ethics. You would have come across that particular framework in your E1 studies. Remember the 5 principles that are covered by the CIMA Code of Ethics: objectivity, professional competence, confidentiality, professional behavior, and integrity. So review those principles, make sure you're comfortable with what they are and what could potentially represent a breach of each of those principles. And for heaven's sake, if you are approached by a member of staff that is looking to do something unethical, even though it might be profitable, you need to take the high road. CIMA wants to see that its trainee accountants, the management accountants of the future, are ethical professionals. They reward ethical recommendations well, and particularly if you're given an ethical issue, do explicitly mention the CIMA Code of Ethics. Markers really like to see it being used. So watch out for requests, for example, to present figures in an overly optimistic light. The owners of this business also happen to be the key executives in the business, so they're likely to wield a lot of power. They've been in charge for a long time. It could be the case, for example, that you have the CEO of the company, who's also the main shareholder, coming to you and asking you to recommend that they book revenues for a 2 or 3 year project predominantly in the first year. That wouldn't be the correct treatment. If the service was being spread out over 3 years, for example, the revenues should be booked in line with the rendering of services. But he might be looking to book most of the revenues up front in order to present very positive results for the year. That obviously would be the incorrect accounting treatment from a technical perspective, but it would also be a breach of CIMA's Code of Ethics, and you'll be breaching professional competence would be the principle that you'll be breaching in that way, and objectivity would be compromised as well. So as I said, take the high ground, the moral high ground, and make sure that you're making ethical recommendations.